Hello, happy Friday. How are you?
I'm doing well. How about you?
Excellent. So, Michael, I know a lot of folks have been asking us for obviously stories from back in your day, and just I think stories always tell a really good story when it comes to being an entrepreneur. So, would love for you before we kind of kick off our session for you to share a story that comes to mind from your days as, as an entrepreneur and surviving and thriving through the 2008 financial crisis.
Yeah. Hi, everybody. Victoria reminds me, we were just talking about one the other day when in the middle of the financial crisis, things were going pretty crazy. And my office was out in northern New Jersey. And I was driving around. I went into a gas station to get some gas and get a cup of coffee.
Michael, hang on a second. Hey, Sadesh, can you go on mute, please?
Okay, yeah, sure, sure.
Thank you.
And so I pulled up to the gas station and put the nozzle in my car and went in to go grab a cup of coffee and walked out and jumped in my car and drove away. And I had a million things on my mind, like we always do all the time. I forgot one small detail. I had left the nozzle of the gas in my car and just drove away and basically pulled down half of the stanchion of the gas station. And it just reminded me of the entrepreneurial journey. And of course, once you pull it down, you should be like, oh my God, your first thought is, oh, I got to do this now, I'm late, whatever. So it's just, we always get caught up in our entrepreneurial journeys and try to destroy a gas station along the way. First of all, again, thank you everybody for taking time out of your busy day. We're going to talk about a little bit about financial statements. I know for some of you, this is very simple, normal topic. And for others, this is literally like a foreign language. Just so I can get a little bit of grounding of everybody. Is there anybody here that is here because financial statements is just one of those really kind of, I don't get it, I don't understand it, I know I need to know a little bit more about it, but I just don't know very much at all? Can anybody kind of chime in, raise their hand if that's them? And please don't be embarrassed, a lot of people are like that.
Yep, we have a couple. Michelle, there you go. Thank you. And I'm right there with you. We have a couple folks.
Okay, great. So I'm going to try to give you and give us a little bit of the foundational basics. What I'll start with first and foremost is that we all know when we start a business, a lot of different areas that we have to know. But the perspective I want us to have is that we as the leader, or you as the leader, you don't have to become an expert on everything, right? It's impossible to do that. If you woke up tomorrow and said, well, I'm going to learn everything about raising money. Well, there's people spend 30-year careers just about raising money. So it doesn't necessarily make you a great leader, great entrepreneur, if you're like, I'm going to lock myself in my basement and learn everything that there is to need to know. Sometimes it's better to know what you know what you don't know, and where you have to go for help, okay, from others. And help doesn't mean you have to write checks, and we'll talk about that a little bit. But that being said, understanding the basic financials of your business and what that means is, at least to a certain extent, important that everybody has some foundation for that. If you're going to talk to a customer, an investor, an employee, you need to know some of the basics, okay? So what we wanted to do here today is to talk about the three major types of financial statements that exist, what they mean, and how they are used. Okay. While I go ahead and do that, I also want to remind everybody that in the learning community that you're all a part of, okay, which I'm going to show you something right now. Oops, excuse me. In the learning community, you will see one of these learning modules called finance, or one of these learning areas called finance. Okay. In some of your programs, it might look like this. In some of your programs, it might look like this. Okay. Within this, okay, there are lots and lots of great learning modules here about a cash flow forecast, what the basic financial statements are, okay, all kinds of different stuff. And today, we're going to cover this topic, which talks about these main financial statements. Okay, so much more to learn along the way. This is just, I wanted everybody to understand where you can go, after this to get more. Okay, so there are three basic financial statements. Okay, one is called an income statement. It is often also called a profit and loss, or P&L. right? And an income statement's main purpose is to show you what you're selling, what your expenses are, and how your business is actually performing. Okay. The income statement is usually the best indicator of how you're doing kind of on an ongoing basis. And I'll spend a lot of time on what that is. Secondly, is your cash flow statement. Your cash flow statement says exactly what it sounds like, which is when cash is coming in and cash is coming out. Okay. Now that sounds a lot like an income statement, but they're different, right? Because an income statement, which I'll explain in a minute, I'll give you an example. Let's say you sold $100,000 of widgets to IBM and you created an invoice, right? And you did that in March. That $100,000 would go on your income statement as a sale, but you haven't collected the money yet. You haven't collected the money. You might not collect the money for, let's say, 60 days. So the 100,000 goes on your income statement. It says March we sold 100,000, but on your cash flow statement in March it has zero. It's not until you collect the money, right, that it shows up on your cash flow statement. So income statement is certainly your revenue and your expenses, but cash flow is actually how cash comes in and out. Okay. The third statement is called your balance sheet. And your balance sheet is the reflection of three things: your assets, right? So assets are things like cash, inventory, intellectual property, right? The things that you own, real estate, okay? And your liabilities. And your liabilities are your things that you owe, right? These could be bank loans, right? Debts that you have, accounts payable, which is what you have to pay to your vendors, right? And the way it works is your assets minus your liabilities equals what they call your equity you have in the business. Okay, so and I'm going to explain to you for each of these statements what they mean, what they're used for, and what good and bad means. Okay, but again, to summarize: income statement, statement of cash flows, and balance sheet. Now, if you walk into anybody that's going to give you money, other than maybe people that have the same last name with you, and probably them too, right? They should be asking you for all three of these things, because these three things together tell you how your business is doing. Okay. So these are things that you should get to know. So let's start first and foremost with your income statement. Your income statement, or as I said before, sometimes called your profit and loss, is an indication of what you're selling, what your expenses are, and what kind of profit you're making. Okay, so let's take a very simple example. I'm in Peoria, Illinois, right? And I have a lemonade stand on the corner, and I sell lemonade. Okay, and I go and somebody walks by and I sell a pitcher of lemonade for $20. Okay, so my income or my revenue, the first part of an income statement is your revenue. My revenue is $20. Okay. Now, but I've also got expenses, right? I had to hire somebody to sell the lemonade. I had to get lemons. I had to buy a pitcher, right? I have a bunch of expenses, right? And let's say I had $15 of expenses. Okay. So my revenue is 20, my expenses were 15, my profit, if you will, is $5. Okay. That's the function of an income statement. Now, if you work for Pfizer, right, that revenue says we sell drugs. It sells, we have, our expenses say we have, research and development and people and whatever, and we make a certain profit. Okay. So your income statement is basically telling you is this is really how your business is performing month to month. Okay. So when somebody says, hey, COVID happened and your sales went down, that's what they're talking about. They're talking the first part of your income statement. Okay. And income statements are, all of these statements are things that are produced out of accounting packages and the like that gather up all the money that you're taking, all the revenue you're generating, all the expenses you're incurring, which includes everything, and ultimately result in your profit as a business. Okay. Now, a really, really important point is the one that I made before about cash, right? Just because you sell something doesn't mean that you get the cash. Now, in the lemonade stand example, you probably do. They probably walk up and they say, I'll give you $20, right? But in my Pfizer example, when Pfizer sells $1 billion of drugs to somebody, they probably don't pay for it like they pay for a lemonade stand. They might pay for it 6 months later. So in that case, you'd have $1 billion of revenue on your income statement, and you'd have on your cash flow statement, the cash would not show as coming in until you actually receive the cash. Okay. So one really, really important thing about running your business is to understand that just because you sell something is not the same as getting money. So it's super important that you have process and structure and procedure to bill your customers on time, to collect from your customers on time, right? Because ultimately cash is what pays the bills. Okay. And those two things work together. Okay. Um, Obviously, when you look at your income statement, if you talk to people that are raising money, where you're trying to raise money from or get a bank loan from, they're going to ask you for your income statement normally on a month-to-month basis. Why? Because think about if we were all investing in the lemonade stand, we would say, okay, how much lemonade did you sell in month one? How much lemonade did you sell in month two? And month three, people want to watch the trend, right? And at the same time, they want to see our costs, right? If in month one we had $15 of cost, right? That's okay. But let's say in month two we had $25 of cost. So we sold 20, but it cost us 25 to sell, right? So income statements show a trend of performance over time for your business. Okay. And then as you grow, and if you happen to be fortunate enough to be in the gourmet salsa business for 10 years, you could look back at your income statements, and on those first income statements, you might cringe a little bit. You're like, oh my God, we were so small. And then you show, the growth over time. Okay. So income statement is the first and probably the most important financial statement. Let me stop there and see if anybody has any questions about that. Make sense?
Hey, I actually have a
Cool.
quick question.
Oh, go ahead. Sorry. Somebody does have a
Um,
question. Go ahead.
yeah. So where does the accrual cash method?
I can't hear anybody, V.
Ooh. Hey, Charlie,
Yeah.
can you speak up just a little? It's a little hard to hear.
Sure. I was thinking about where does the accrual or cash method comes into play?
We're going to level 2 now. Good stuff. There are two ways, and I don't want to go too deep into this, not just, I want to make sure we get to the base. There's two accounting treatments you can pick. You can pick cash or accrual. If you pick cash, then your cash flow statement and your income statement are exactly the same. You only put something on your income statement when you actually get the cash. So in my lemonade example, you only get it when they pay you. If you are a cash, right, method. If you're accrual method, which most bigger companies are, then it's not just when the cash comes in. It's as I previously described it. But it's a really good point, Charlie. A lot of early stage companies, if you have an accountant or the like, they will ultimately advise you whether to do cash or accrual accounting. Cool. Any other questions, or are we good?
I think we're good for now.
Great. Okay.
Oh, no. I have a question. I'm still trying to figure this out on my phone. This is Angela. I apologize.
Hey, Angela, go for it.
Hey, Michael, I could be jumping ahead, but help me correlate the gross profit aspect.
Sure.
I mean, I'm familiar with the gross profit. Obviously, it's, everything before the bills come out. But how does that relate to the income statement?
Sure. And in fact, I'll go a little bit deeper overall in the income statement to a couple other terms like gross profit. Okay. So I mentioned before, revenue minus expenses equals your kind of profit, but there's other pieces of that as well. There's different types of expenses. Okay. One type expenses are the expenses you incur to actually produce your product. So in my case, this is the lemonade, right? We need lemons. So anything it costs to actually produce your product or service, right? That you subtract from your revenue to get your gross profit. So for example, let's say we sold $20 of lemonade and we spent $3 on lemons, right? That $3, right, are your essentially, they call them cost of goods sold, or COGS, COGS, right? So your gross profit is the 20 minus the 3 equals 17. 17 is your gross profit. And a lot of times that's expressed as a cost. I'm sorry, as a percentage. Okay, so businesses like software companies have very, very high gross profits, right? Because it doesn't cost them a lot to actually produce the thing. Okay, but if you build a house, right, your house the price might be $100,000. The cost of producing that house with materials and labor might be $95,000, right? So you have a low gross profit, in that case, 5%. Okay, that gross profit is telling you what kind of business you have. Now, all the other bills, right? Your accountant, your lawyer, all of the what I'll call fixed costs, that is called what they call SG&A, selling, general, and administrative expenses. And those are the other types of expenses that get subtracted from gross profit to get your what they call net profit.
Thank you.
I hope that's helpful.
Yes, very.
Yep. So the way people look at financial statements is they look at that gross profit and they say, okay, when they sell a product, do they make a lot of money? Right? So if you have a business, for example, like a supermarket, they might buy a banana for $1 and sell it for $1.10, right? That's not a very high gross profit business, right? If you look at Salesforce or another software company, they might, for every $100 they sell, it might cost them $5 because it's software. High gross profit businesses are very much liked by investors because they make a lot of money when they sell things. Now, you still have to take into account all those other selling, general, administrative expenses like your marketing and your sales and all that other stuff. But gross profit businesses, you're looking for the highest gross profit that you can get. Don't get me wrong, there's plenty of businesses that don't generate huge gross profits that are still great businesses. Okay, so let's take an example of our Fortune 500 executive who's now going to create a voice business, right? Which you have a great voice, so Barry, it'll be fun. So you say to yourself, okay, I'm going to do voiceovers, and I'm going to go charge $1,000 to do a voiceover for 1 hour of my time, right? That's a pretty high gross margin business. But let's say in the future, Barry, you had to hire somebody else that had another voice like yours. Of course, there's no voice like yours, but let's say there was. And let's say you had to take that person and you had to pay that person $800 to do that $1,000 voiceover, right? Then your gross profit would be $200 or 20%. Okay, that's okay, but it's not not as high as, for example, a software business, right? So that's how gross profit tells somebody whether a business is one that can be profitable. Okay, and on your income statement, you have to manage all of these pieces. You have to manage, in my example, the cost of producing your goods or services, or cost of goods sold, right? Or you have to manage your sales and your marketing and all of your other costs as well. Okay, so want to sure if that makes sense. Victoria, does that make sense to you?
It absolutely does. And we actually had another question come into me. So I'm an early stage entrepreneur. When do I have to start tracking kind of all of my expenses and obviously financial aid material? And then when do I have to start to worry about income statement, balance sheets, and all that fun stuff?
So if I asked everybody a question, which I won't because I don't want to get anybody in trouble, of people that actually track their financials from the beginning, almost the answer is from everybody, almost never, right? Right? They don't do it. They're putting things on credit cards and they're doing this and this and this and this. Okay. The right answer is you should be doing it right from the beginning, right? You technically shouldn't be mixing up your personal stuff and your business stuff. You should have all of that separate, and you should keep it separate. Here's some of the easy ways to do that. There are accounting packages out there. One's called Wave, one's called Xero, which is Xero. These are free or very, very low cost accounting packages. In these accounting packages, what they allow you to do is automatically integrate with your bank account, right? So that means that when you go put something on a debit card or a credit card, it automatically puts it in there so that you get to, it's not as simple as pressing a button, but all that stuff is in there, and then you can go out and take out personal things like that. But even if you do it on the back of a napkin or an Excel spreadsheet, you should be tracking every single one of the expenses that you have specifically related to the business. Okay, once you have to do anything formal, you're going to need an income statement, right? And one of the best ways to discourage somebody from learning more about your business is if you can't produce those income statements relatively quickly. Okay, so you don't have to necessarily buy an accounting package. You can get one for free, but by the same token, you can just scratch it on the back of a napkin, or keep track of it in an Excel spreadsheet, and that'll get you be off to a pretty good start.
Yeah, this gets us back to when we talk about process, right? If you want to be successful, you got to implement process from day one, just so you're organized and it doesn't become a hassle, every month when you have to sit there and figure out, okay, what business is personal, right? Expenses and all that fun stuff.
Yep.
Totally. And another question, is the net profit what is referred to as bottom line?
It is, and you can see, I hope with the way I explained it, why it's at the bottom, right? Because you have at the top revenue, then you have your costs of your revenue, your cost of goods sold, and that results in your your gross profit. Then you have your other costs, your SG&A, right? And then the bottom or bottom line is your net profit, what you actually end up with after you, right? $20 in lemonade, it cost me 15. I had to pay a person $3. My net profit is 2. Okay.
Yep.
So again, you don't have to become experts on this, but you do need to start to understand a little bit about your business. I did a conversation yesterday for some folks down in Fort Bend in Houston, and they were talking about cash flow, and they were doing $80,000 in sales a month. And I asked them this, and I said, so when you do your $80,000 in sales a month, how much money do you make? And they didn't know. So, okay, you've got, do the math, almost $1 million of money going in and out of that business, and they didn't know how much money they were making. Like, that's not okay. Okay. So there's a lot that needs to be done to put this stuff in place to make it valuable for your business.
Great. All right. And Chris just put a really good comment in. He's always used QuickBooks, only 200 on sale, and buy the software once every 2 or 3 years. Excellent importing charts and ways to manage your business, plus standard format you can send to your CPA Protect filing. So absolutely.
Yeah, there is sorry, Victoria, I'm going to show some people in the community one more time. We have a section in our community about reviews of the different tools that you need, right? So you'll see something that looks like this, right? And we bring in reviews of the top third parties in all of these areas. And here's the one you see on accounting, right? So you can go in there and it'll explain to you, here's the stuff to think about. And here's a bunch of the different solutions that we talked about. So we mentioned, and a bunch of descriptions on each of them. Okay, so, there's ones, and again, not a lot of this costs money. Like Wave is free, Xero is $9 a month, FreshBooks is another good one, and also QuickBooks, which is a little bit bigger, but all great solutions. And these are things that you can literally just connect your bank account. You just connect it with usernames and passwords, and is really valuable. So whenever you're looking for solutions, you can go into that section called Review of the Tools You Need, and it gives recommendations that we bring in from third parties that we think are the best.
All right, and another question. Dealing with finances scares me. What can I do to not do this?
What can you do, what?
To not do it.
Come on, you can't scare easy if you're going to be an entrepreneur. It doesn't work that way. But it's a really important point, and we wrote a lot about this in the book, and there's a learning module on this under the area called managing yourself. You have to know what you're good at and what you're not good at, and you have to know what you like and what you don't like. Okay, because think about it. There are people that are, I don't know, technologists that would sit up all night long and drink coffee and write code and would love it, love it, love it, and never get tired of it. But if you ask them to do a financial statement, it's the last thing they'd rather do. What you have to understand is you as the leader of the company feel as if you have to do everything. Okay. And that's not the case. You'll get frustrated over time. You won't be good at it. You have to say to yourself is, okay, I know finances is a part of my business. I don't know it. I don't like it. How do I solve this problem? How do I bring in somebody to help me? Right. Now, obviously we help people with it, but you could even go to a local college, right, and get a MBA student, right, and ask them to help you with basic financial statements, right? So there's ways to be creative, okay? There may be local resources you can take advantage of, but you have to understand a little bit of it, but you don't have to become an expert in it. Okay. And there's you can go on Upwork and get an outsourced financial person to help you for a couple of hours here and there. So there's lots of different ways to solve it. What I want everybody to, and I know some of you are probably like, hey, this is simplistic stuff. I know this, and that's fine. But everybody needs to have a basic financial understanding of their business, or they can't talk to banks or investors or anything else that's going to help them grow their business. Okay. V, we ready to move on? Awesome. Terrific. So now I'm going to move on to, I just got another question. As a small business startup, is it best to have bank accounts established for the business to help manage income and expenses? Absolutely. Absolutely. You should. Doesn't cost you anything in most cases, especially these days. Let's say you have a personal bank account with a bank. You should call up the bank, say, hey, listen, I'd like to add a business bank account. These days, less and less, they're requiring minimum balances. I mean, sometimes they're pretty small. You absolutely should be keeping this stuff separate. Let me give you the alternative. The alternative is you sitting down at the end of the year with 500 transactions in your bank account, and some of them are I bought groceries and some of them are for the business, and you got to separate all of them and figure them all out. It's just better to get a separate bank account, right, and do all your stuff separately in that bank account. Okay, cool. Let me move on to your statement of cash flow. Statement of cash flows is exactly what it sounds like. It's just how money comes in and money goes out. Okay, so what does money come in from? Money comes in from getting paid by customers, right? Money comes in from financing, like investments or bank loans or PPP, right? Those are generally the main sources of money coming in, right? So your cash flow statement reflects when that money actually comes in. I got paid by a customer, right? I got outside financing, okay? How does money go out? Okay, money goes out first and foremost for the bills you have to pay, right? It goes out for, what they call your accounts payable, right? This is your rent, your people, right? The inventory you have to buy, okay? It also goes out for debts you have to pay, such as if you have a bank loan or you have to pay interest on a loan, right? All of those things are things that are, cash outflows. Okay, and as you can imagine, this is obviously common sense, but something that's often overlooked. You have to manage the money coming in and the money coming out. You can't be where somebody says we have $80,000 coming in every month and I don't know if we make money. Okay, because you especially in early stage business, a lot of times we need every dollar that we have, right? So you have to really carefully look at what money do I have coming in and what money do I going out, and what process and structure do we have to put in place to maximize how quickly money comes in and how slowly money goes out. Okay, so let me get into that a little bit. So let's take the example of Barry has a voiceover business. He charges somebody $1,000. Barry could say, you have to pay me before I do the work, right? You sign up, great. We'll book it. I'll do it in a week, but you have to pay me until before I actually do the work. In that case, that's a great cash flow management. You're getting it up front. Okay, but a lot of times somebody will say, well, bill me a week later. we pay 30 days, we pay 90 days, and that's when people start to get in trouble, right? Is that you go to the IBM and you sell them $100,000 and they say we pay people in 90 days, right? Or we pay people in 30 days. So that's where, you've had a good sale, right? But you haven't, collected the money yet. Okay. So that's why you have to actively manage that. How do you actively manage it? One way is you ask for payment up front. Another way is you ask for partial payment up front. Hey, we're going to do a technology project. We ask for 50% of it up front and 50% of it when we complete the project rather. Okay. The other way you can do it is by billing more frequently. Let's assume you're providing a service over the course of a month and you're charging $10,000 a month. Well, first of all, you could bill at the beginning of the month, right? Now, somebody might say, well, I don't want to pay before you provide the service. You could say, great, I'm going to bill you at the beginning of the month. We're going to provide the services. And then on the 31st day or the first day of the next month, you're going to pay for it. Okay. So think about the difference between that, billing day 1 and getting paid on day 31 versus billing on day 30 and getting paid on day 61. Okay. You can do also things like billing in the middle of a month, right? Instead of having a bill that's for a whole month, you put 2, right? So you collect bits and pieces. So, but the point is to bill, right? And set up what they call your payment terms to be as early as you possibly can. Okay. And that's a super important part of it. The other part of that goes hand in hand with that, and that, by the way, is everybody may know this, so I apologize for insulting people. That's called your accounts receivable. When you create a bill that has to be paid for later, it's called your accounts receivable, or AR. Okay. But what goes with billing is also collection, right? It's all fine and good to bill and say you're supposed to pay us in 15 days. But what you want to do is have a regular process for collection. Not I call you in the middle of the night yelling and screaming because I need this money to pay the bills. No, it should be every week, every 2 weeks, regularly, right? Reaching out to your customers that haven't paid and saying, hey, this is due, hey, this is due, hey, this is due. The key is that is a regular, consistent process, right? When you call up a company and you haven't talked to them for 30 days, right? And you say, I'd like to get paid. They're like, oh, we lost it. Can you resend it? And it's another 40 days. Well, to them, to IBM, it's no big deal. To you, it's a lot. Okay. So that's why regular, consistent process to collect. And that way there's less jumping up and down and freaking out because you know what's going on at every step of your process.
Great.
Okay?
Michael, I have a cool question from somebody. Do you want me to wait or do you want me to answer?
No, go ahead.
Okay, so the question is there financial help for inventor for patent filing and product development?
So 2 different things, right? One is for patent filing. Yes, there's a bunch of organizations that can help you with patent filing. The only thing I would say to you is a lot of them are slimy. A lot of them, we've all seen those ads that say, hey, we're going to turn your patent. You have to be very, very careful. So what I would suggest is if you're near a local university that has a science program and stuff like that, a lot of times the professors and the like have relationships with local patent attorneys and stuff that can help you. There are also more creative programs these days about not so much just patents, but about different science-based inventions. So I don't know where the individual is from, but I think that there's ways to take advantage of local resources that help people put together patents. And then there's also the office in the United States that handles patents and trademarks. Is called the U.S. Patent and Trademark Office, or USPTO. They actually have a program that will help you for free. It's not, you don't get all the guidance in the world, you get a little bit, but it's a lot of times those programs will also refer you to others to be able to help. Okay.
Great, thank you.
Cool. Okay, so we talked about cash flow statement, right? And we talked about managing your inflows, how often you bill, how often you collect, and making that a regular and consistent process. And that's really important. And in these learning modules, I'll show you another one because there is one specifically about a bunch of different processes to Just give me one sec here. When you think about billing, collections, and payments, there's a whole section here, right, that gives you a whole bunch of tools and techniques about some of the things that I've been talking about. Okay. So now when it comes to cash outflows, right, your job is to manage and minimize those outflows. Now we have to pay our bills, of course, but a lot of times we want to take as long as we can to pay those bills, right? So that means you negotiate better payment terms to say, we would like to pay not in 10 days, but in 30 days. Okay. There are also ways, for example, let's say you buy insurance. You could buy insurance where you pay all of it up front, or you pay a little bit more to pay it monthly. Okay, so think of the difference. Let's say you pay $5,000 for insurance a year. You could write a check for $5,000 today. That's $5,000 gone. Or you could pay $500 a month. Okay, now the $500 a month at the end of the year costs you more, right? Because it's $6,000 in total. But in month one, instead of being out $5,000 in cash, I'm out $500 in cash. Okay, cash flow management is equally important to how well your business is selling, right, and managing expenses is managing your cash. Okay, now you want to be a good partner, you want to be somebody that pays on time, right? But by the same token, you have to be able to manage your cash effectively. Just to give you a typical example, if you go to a very large company, they will typically start, when they negotiate contracts with you, they will usually start at 60 days, that we want to pay you in 60 days. Right? And then you try to negotiate that down to 15 days or 30 days is a pretty common place where people end. But I can tell you, most big companies that agree to 30-day payment terms usually pay you in 45 days. Okay, so this is just a matter of being a good business person and managing your cash flow. Okay, so remember, we got our income statement, right? We got our what we're selling and what it's costing us to sell it, and that ends up in the bottom line or net profit. We've got our cash flow statement, which is related to that, but it is actually the cash going in and out. Okay, so you can imagine I could have a really nice looking income statement. I just sold $1 million to IBM, right? But when I look at my cash flow statement, if they don't pay me for 60 days, then in this month I have no cash. Okay, so both have to be looked at and managed. Okay, the third financial statement is what's called your balance sheet, and this shows your assets and your liabilities. And your assets, as we mentioned before, are how much cash you have. It's what your accounts receivable, right? How many invoices you have out there to customers that haven't been paid. This could be a building. This could be inventory, right? If you're a car dealership, probably your biggest asset is your cars, right? Your inventory they have. And then that is offset, if you will, by your liabilities. Your liabilities are your accounts payable, right? The things just like there's accounts receivable, there's accounts payable. These are the things that you owe, right? And that you haven't paid yet. And then your other debts like loans and the like, and those assets minus those liabilities is what's called your equity. Generally speaking, right, you want your assets to be greater than your liabilities, right? You want your good stuff to be better than your bad stuff, right? And when you do have assets greater than liabilities, you have positive equity, and when you don't, you have negative equity. So a big red flag for a business that isn't that healthy is that your liabilities are greater than your assets. Okay, balance sheets are a little bit more complicated, and they're a good indicator of how your business is doing over time. But those three financial statements, income statement, balance sheet, cash flow statement, those are the three major financial statements. There's one called statement of retained earnings, which is a little bit about the equity of the company. I'm not going to spend so much time on because it's not as normally used. But an understanding of those three statements hopefully gives you a chance to manage your business a little bit better. V, let me stop there, see if there's any questions.
I do not have any questions right now. I think the ones that I've had, we've been answering. as we're going.
Cool. I just got one that was sent to me. Is there a place where you can find a pure play to see what is normal for your business? Good question. So there's a lot of information out there that for certain types of businesses, what is normal or good, right? So if you said, well, what's normal for an accounting firm? What's good for a pizza stand? You can Google around that and say, and there's a good amount of information about, how much you should be spending, what percentage of marketing do people normally spend in a certain type of business? What are people spending on operations for different, it's not an exact science. But it's always a good indicator to say that the companies that perform really well in a particular sector, this is what their economics look like. They spend this much on this, they spend this much on this, right? I'll give you an example that some of us may be familiar with. You hear these days about the content wars. Netflix and Apple and Amazon and Disney are all spending all this money on content. Netflix is going to spend $19 billion on content. You can find information on who is spending what on different pieces. In terms of the whole financial statement, the whole income statement of what people spend, you can get some general guidelines about what people spend. But there are companies that are outliers, both good and bad. Ones that are more successful, and others that are not. Think about Starbucks, right? Starbucks' biggest expense is real estate, right? It's not coffee. So their gross profit on coffee is probably pretty high. We all see them pour a cup of coffee and we're like, wow, that's $4. That's a pretty good deal. But remember, so their gross profit is really high, but their SG&A, right, which includes their real estate, which is like rent payments, is enormous, right? So they need to sell enough coffee to, they're making money every time they sell one, but it's got to offset those costs of their fixed costs.
Yep. Michael, and we just got a great question in from Simbo. Thank you for that. Are there key metrics to look at monthly and to include in a high-level monthly financial dashboard? Great question.
Yeah, there's metrics across all of these. I'll start with the income statement first. Certainly, your gross profit percentage is very important, right? If you're selling things and you're not making that much money when you're selling before your other expenses, that's a big red flag, right? So you really want to be watching that gross profit metric. You of course want to be watching your net profit metric as well, but definitely gross profit, because if you're working really hard and you're selling your lemonade and it's costing you $21 to sell $20 of lemonade, you really got to fix that first, because if you're not making when you're selling, nothing else really matters. I think that with respect to the cash flow stuff, some very specific metrics. With respect to, for example, your accounts receivable, a metric they call days outstanding. So that means from the day that you cut the bill to when somebody pays you, you never want that to be more than 30 days, right? And that's hard to do because I said before, like big companies regularly pay 45. So you want to be looking at the days outstanding across your accounts receivable. Okay, and you want to be actively managing to a number as close to 30 as possible. Okay. The same thing is true on your accounts payable. On your accounts payable, which is kind of the opposite of that, which is when you pay, you want to be stretching that out as close to 60 days as you possibly can, right? And again, the best way to do this is by negotiating, but just like large companies do, it's also by managing when you actually pay the bills. So that's a big part of it. Another metric that you really want to be looking at is your accounts payable versus your accounts receivable. Like if you got a situation where the money that you have going out is greater than the money you have going in, that's an indicator, obviously. And the more kind of deep that problem is, the more systemic your issues are, and you have to kind of get into what you're doing. But I would say probably the biggest indicator is going to be the days outstanding of your accounts receivable, and you have to actively manage that. People bills just don't pay themselves. Think about when we pay bills. Sometimes we do it in an automated way, right? But in a lot of cases we don't, right? And so you have to actively manage and put in place process to do that. Now, there are tons of other metrics that I'm not sharing here So for those of you who are interested in a deeper dive, we can certainly do a deeper dive on those, because as you can imagine, in every one of the pieces I mentioned, there's metrics. There are metrics of the percentage of sales you're spending on marketing, on technology, operations, right? There's productivity measures. There's measures with respect to other cash flow measures that are all part of a more sophisticated financial dashboard, if you will. But when you talk about the ones that really drive your business, it's what profit are we making when we sell? What profit are we making when we get to the bottom line? And ultimately, how long is it taking us to collect from our customers, right? Because that obviously drives the need and use of cash. Okay. V, I just have a couple more things I want to cover, but do you have any other questions before I do?
I do not.
Is there any, before I go to the last couple minutes here, is there anybody out there that's just completely freaking out about this topic, and it just doesn't, it sounds like Swahili to them?
Please don't be shy.
Okay, cool. Well, don't hesitate to reach out here or separately. I think that a lot of times it seems like a lot of really, really hard work to put in place some of the process stuff that we talked about in the beginning, like an accounting package, like separate bank accounts. Trust me, it's worth your time. And by the way, there's plenty of people that can help you do this, right? This is, if you don't have experience with this, going to get one of those accounting packages is easy. You can go get a local MBA student, right? A local college student that probably works with these packages all the time. Integrating in your bank accounts is super simple. And those bank accounts include your traditional bank accounts. They also integrate in your things like your credit cards and your debit cards, right? So everything that you do goes into those accounts, and then you have everything in one place and you can go kind of figure it out. The other thing is when you create invoices, right? How many of you have created invoices on the back of a napkin, right? You go into these accounting packages and you just create them. You said, this is my customer and it's $10, and you press a button, and not only does it send it to them, but it reminds them automatically, when they should be paying. Okay, so if you haven't already, it's worth looking at one of these. And I mentioned, things like Wave and Xero and even QuickBooks are super inexpensive especially for very small businesses. The other is definitely getting separate bank accounts. Okay, keeping your business expenses separate from your personal expenses. You can do that with a bank account, and you can do that with separate, debit cards or credit cards as well. But do the best you can and try to keep things separate. Don't get me wrong. Every once in a while, the circumstances are that you have to use a personal credit card to charge something, an airline flight if we were flying on airlines and all those types of things. But getting this stuff organized in the beginning of your business, and if you're in the middle of the business, moving it towards that. A great time to do it is if people are probably finishing up things for last year right now, right? They're gonna have to file taxes in a little bit, and all of us that don't do this, people are going, oh man, I wish I had done this, because now you're gonna unfortunately scramble around and try to figure it out before April 15th. Okay.
Is it okay if I just share a quick comment?
Sure, of course.
Totally.
Okay, hi, this is Sherry. And you may have said this, and I was eating, but the most important thing is to understand what they're looking at, not to be the the financial person per se, but going somewhere. I know that in the past, like SCORE and SBDC offered these workshops to help entrepreneurs understand how to interpret it. Like if they've, the financial statement is not good or whatever, but they've got to understand what they're looking at. And that's all I wanted to share.
Yeah, I mean, it's a great point, Sherry, because the reason you put these in place is actually so you can analyze, right? So you can actually say, here's what happened. Here's a trend, right? My lemonade cost me $17 and then now it cost me $21. Well, we've all experienced that, right? In COVID, right? We've seen prices go up for things and prices go down for others. So the goal of getting your financial statements and getting them in place and being able to see them regularly is that you actually get to analyze what happened and what's happening, so you can make adjustments to your business. If you see that your accounts receivable is really growing and it's taking you 45 or 60 days to collect, you got to go, oh, I got to change that. I have to do something to try to impact my business. Remember, everybody, and this kind of maybe goes unsaid, entrepreneurism is a series of a whole different set of skills, and this is just one of them. But what's foundational about financial statements is they tell the story of how your business is doing, and that's why they're so important to get at least a basic grasp or understanding around. Okay, Victoria, anything else before we close out?
Sorry, guys. Yeah, I think that's great. And Pilar just shared kind of her process of how she does it. And that's great, Pilar. Definitely, especially if you're dealing with a small vendor, they get paid faster.
Yeah, totally. So remember, within the learning community, you've got all those learning modules. Make sure you're signing up for the community and take advantage of, not only these sessions, but those learning modules that are there. And don't hesitate to reach out to us at the team and see if we can help in any way.
Yes, please feel free to reach out. We're always here to help or answer any questions. Thanks, Bea.
Thank you, guys. This was great.
Thank you, Angela.
Have a terrific
Thanks,
day.
everyone. Have a great weekend. We'll see you next Friday.
Thank you.
Bye.
Thank you. Take care, everyone.
Hey, Michael, are you still there?